All right, joining me once again here on the Matthew Filipowicz Show is my friend David Dayen. David is an independent journalist whose work you can find at davedayen.com. You can also find him on Twitter at ddayen. David, thank you so much for being on the show again.
Thanks for having me once again, Matthew.
All right, so David, we have a lot of stories we want to get to here. Where I'd like to start is you actually have a great piece up at Salon about how the new student loan, air quotes, fix is actually a giant sham. Tell us all about it.
All right. Well, as we know last week, or I guess it was July 1st, interest rates on student loans doubled on the federally subsidized Stafford loans. Went from 3.4% to 6.8%. And this also happened a year before. In 2012, there was a threat that this was going to rise. And Democrats sort of held their ground and said, no, we need to extend this. We can't put this burden on students in troubling times. And Republicans caved. And the interest rate was advanced for 1 year at the 3.4% rate. This year, that didn't work, and the reason that didn't work is that in President Obama's budget, he put in this provision to deal with the interest rate over the long term by tying it to the market, tying it to 10-year Treasury bills and saying that the student loan interest rate will forever be a certain amount of percentage points above that Treasury rate. It would be fixed for the life of the loan, so when you get the loan, the rate stays the same. It wouldn't be variable depending on, what day it is or anything, but it would vary from year to year. So Republicans actually agree with that. They also wanted to tie these interest rates to the market over the long term. They wanted a variable rate, like I just described. But that's a detail, and those details apparently got ironed out. And there's now this compromise in the Senate that is similar to what the House already passed, which is tying these interest rates to the market rate. I guess there was a problem with it. It costs too much money, so they need to extract more money from students. So they'll figure out a way to make this cost neutral. But in the long term, what this means is because interest rates are so low right now, that this is probably the lowest interest rate you'll ever see for a student loan.
And right now, it would be around 5% about where it would be
around 4.5%, I think. Mm-hmm. It's a certain percentage, as I say, above Treasury rates. Treasuries are running at about 2.5% right now, the 10-year rate. So I think it's almost 2 percentage points above that for the lowest rate, the subsidized rate. Well, that Treasury rate's going to go up, and it's going to go up because the Federal Reserve has also already indicated that interest rates are going to go up in the future as the economy stabilizes. And so basically you're getting a somewhat lower rate now, but that's going to increase in the future. So future borrowers of student loans are going to effectively subsidize current borrowers. They're going to pay more in the future. And this was totally expected, as I said, once the president put it in his bill. It's a pretty weak compromise because it's first of all higher than the 3.4% rate that students were getting for the last 6 years. It's going to go up in the future. And the third point I would make is that this is mostly irrelevant to the real crisis in student debt. It's much bigger than an interest rate. It's about the fact that people have to take out these loans at all, that college costs have skyrocketed so much that we have this problem where we have over $1 trillion in student debt outstanding. And the fact that you can't discharge this in bankruptcy, you can't refinance it. The government can garnish wages and paychecks and tax refunds and even Social Security payments to grab money owed in student debt. There are sort of differing statistics on default rates, but effectively, because you can't escape this debt, the default rates are infinitesimal. You cannot get rid of this. You have to pay it at some point. It's not a loan. It's more like an indenture. It's more like indentured servitude. You're going to have to pay this at some point. You don't get any of it forgiven. So, tweaking the rate at one level or another is just such a minor detail when you're talking about burdening students when they're 18 years old with this massive debt that they can't escape, that threatens their economic well-being. I mean, the Federal Reserve has already done reports that show that when a student comes out of college with $100,000 in debt, they put off large purchases like autos or homes, and this has a definite bad effect on the economy. The startup, those startup purchases are being deferred, and that obviously hurts homes, the housing market, and it hurts the auto market, and it's a major problem long term. We have to stop financing higher education in this way that puts so much of a burden on kids at the very beginning of their lives and their working careers.
I'm talking to David Dayen, independent journalist, and you're absolutely correct about the interest rate thing. On the broader scale, it is a small part of a very, very big problem, but it is also really funny that, just the whole idea, I know Elizabeth Warren, actually really tried to battle to actually have an actually fair interest rate that at the rates that we actually loan to the big banks and to Wall Street and whatnot, and that wasn't even part of this conversation, it appears.
No, it wasn't. And I mean, for all the theatrics, this "don't double my rate" social media campaign and things like that, the reality is that Democrats and Republicans, by and large, excepting, of course, Elizabeth Warren and a lot of House Democrats and Senate Democrats who did want to extend the current rate, but by and large, Democrats and Republicans agreed on this. They wanted to move back to a situation where you tied the student loan interest rate to the market rate. And maybe that makes sense if, you say, well, this is an unsecured debt, there's no collateral on this loan, and so it should have a higher interest rate than a more safe instrument. But when you add in the factor that you can't escape this loan ever, that necessitates that it's already collateralized. It's collateralized by virtue of the fact that it's permanent. that you can't get rid of it. And so that would tend in Elizabeth Warren's direction, that we need a much lower rate because this is a super safe instrument in terms of the federal government. What she has uncovered is that the federal government, based on Congressional Budget Office reports, will make $51 billion this year alone on student loans.
Wow.
That's profit for the federal government. And that's only going to go up based on this bill because the interest rate is going to be higher and higher over time. And so, she believes, and I agree with her, that we shouldn't be in a situation where we're profiting off of kids who are just starting out instead of making an investment in their future, which will benefit all of us in the long run.